Stablecoin bill becomes law. What's next for banks and crypto regulation? The stablecoin bill has officially become law, and it's sending shockwaves through the banking industry. But here's where it gets controversial. While some see it as a golden opportunity, others view it as an existential threat to traditional banking. Now, banks are scrambling to navigate this new landscape, lobbying regulators to shape rules that could either protect their turf or leave them vulnerable to disruption. So, what's next for banks in this high-stakes game? With President Donald Trump's signature, the stablecoin bill is now law, and banks are gearing up for a battle of influence as regulators craft the rules that will define their future. Experts agree that this legislation presents both a challenge and an opportunity for bankers. On one hand, it opens the door for banks to provide services to a growing, profitable industry or even issue their own stablecoins. On the other hand, it raises fears of disintermediation, particularly among smaller banks, which worry that stablecoins could bypass traditional banking systems entirely. Mike Nonica, a partner at Covington & Burling, highlights the excitement around the new regulatory framework. There's now a robust and durable regulatory framework for stablecoins, which provides clarity for banks and non-bank companies interested in this space. That stability can be very invigorating for technology. But here's the catch. The bill didn't include everything bankers had hoped for. Notably, it didn't ban stablecoin issuers from accessing Federal Reserve master accounts or offering yield-like products, two issues that have banks on edge. And this is the part most people miss. The real battle now shifts to the regulators, who must draft a laundry list of rules. The most critical question? How non-bank issuers can engage with stablecoins. The legislation gives significant leeway to the Treasury Department and state regulators, leaving banks anxious about who their future competitors might be. Karen Petro, co-founder of Federal Financial Analytics, points out, the bigger issue for our clients is what the marketplace will look like and who's coming at them. Meanwhile, the Federal Reserve's role is pivotal. While the bill maintains the status quo on master account access for non-bank stablecoins, the Fed could still decide to change its policy, either easing or restricting access for non-bank issuers. This ambiguity has sparked a heated debate between stablecoin issuers and banks, with both sides lobbying for their interests. For banks eyeing the stablecoin market, legal complexities abound. Nonica explains, banks will need to decide on the structure for issuing stablecoins, whether it's through a subsidiary or another entity. It's a critical decision that will shape their involvement in this space. The yield issue adds another layer of complexity. Will regulators allow stablecoins to offer staking or rewards? This question might be addressed in upcoming market structure legislation, such as the Clarity Act, but its fate remains uncertain. While the stablecoin bill passed swiftly, the market structure bill is likely to take longer. Senate Banking Committee Chairman Tim Scott has already released a discussion draft, suggesting the Senate may craft its own version rather than adopting the House's. This means banks and non-bank issuers are building products in real time as the rules are still being written, a situation Christopher Boone, a partner at Venable LLP, describes as driving on a road as it's being built. Here's the bold question for you. Will stablecoins revolutionize banking, or will they leave traditional banks in the dust? As regulators hash out the details, the industry stands at a crossroads. What's your take? Do you think banks can adapt, or is this the beginning of the end for their dominance? Let's spark a debate in the comments. Crypto's historic victory, the Genius Act explained. A historic week for cryptocurrency in America. In a groundbreaking moment for the cryptocurrency landscape, President Trump proudly showcased the Genius Act, the first significant piece of legislation regarding crypto to be passed by Congress, during a signing ceremony at the White House in Washington, D.C., on July 18, 2025. This event marks a pivotal shift in the U.S. government's approach to digital currencies, which had long been viewed with skepticism and caution. For many years, the U.S. government maintained a cautious stance towards cryptocurrencies, labeling them as too perilous for the average citizen and too volatile for the stability of the nation's financial system. However, this perspective has dramatically changed. Earlier this week, Congress made history by voting in favor of the first major cryptocurrency legislation, indicating a significant transformation in the U.S. attitude towards these digital assets. Following this vote, the total market capitalization of cryptocurrencies soared to an unprecedented $4 trillion, reflecting the enthusiasm and optimism permeating the sector. During a celebratory event on Friday, President Trump, who has expressed his ambition to establish America as the crypto capital of the world, officially enacted the bill into law amidst applause from Republican lawmakers. Today, we take a monumental step to solidify America's leadership in global finance and cryptocurrency technology with the signing of the landmark Genius Act, Trump declared. This new legislation introduces regulations specifically targeting a promising segment of the crypto market known as stablecoins. It also lays the groundwork for additional legislation, as 2 more crypto-related bills are currently progressing through Congress. Among these, the Clarity Act stands out as a priority for the cryptocurrency community. Passed by the House on Thursday as part of what Republican lawmakers have dubbed Crypto Week, this bill aims to transfer regulatory authority over the crypto sector to a smaller agency known as the Commodity Futures Trading Commission, CFTC. This proposed change could significantly alter the regulatory landscape for digital currencies in the U.S., raising concerns among critics who fear it may lead to insufficient oversight of what they perceive as a risky segment of the financial market. The bill is now headed to the Senate, where its future remains uncertain, and opponents of the legislation are prepared to mount a vigorous defense against it. For advocates of cryptocurrency, this week has been a cause for celebration. Proponents have long held the belief that digital currencies represent the future of financial transactions. While they acknowledge the existence of less reputable aspects of the sector, such as meme coins, that are based on internet fads, they assert that cryptocurrencies can deliver genuine value. Stablecoins serve as a prime example of this potential. These digital currencies are considered safer because each stablecoin is required to be backed by a reserve of traditional currency, such as dollars or euros. This means that if you purchase $1 worth of stablecoin, the issuing company must hold $1 in reserve. Companies involved in stablecoins see immense opportunities ahead. Since stablecoins are pegged to traditional currencies, they are effectively treated as cash equivalents. Industry leaders believe that stablecoins will enable individuals and businesses to transfer funds as digital currency globally, instantly, and without the burdensome fees typically associated with banks or money transfer services. For instance, if a business receives $100 in stablecoins, it can easily convert that into $100 in actual dollars, thanks to the backing of the stablecoin. Many in the industry view this capability as revolutionary. Kevin Ledoniety, CEO of Borderless.xyz, a company facilitating stablecoin transactions, predicts, "In the next 10 to 20 years, stablecoins will likely become the standard for commerce." However, not everyone shares this optimistic view. Critics are wary of the implications of the Genius Act. While the legislation does include some protective measures, such as requiring stablecoin companies to maintain adequate reserves and ensuring transparency regarding their holdings, detractors argue that these regulations are insufficient and overly influenced by the crypto industry through extensive lobbying and substantial campaign contributions. Last year, the crypto sector invested over $100 million in congressional races and is amassing an even larger war chest in preparation for the upcoming midterm elections. Amanda Fisher, policy director and COO of the consumer advocacy group Better Markets, expresses skepticism, stating, "It's all hype, and there's not much substance. While there are certainly issues within the current payment system, this bill does not address them. In fact, it may exacerbate many existing problems." Critics warn that without adequate safeguards, the widespread adoption of stablecoins could ultimately harm consumers and the economy. Nevertheless, the stablecoin industry defends the regulations established by the Genius Act, which received considerable bipartisan support. Dante Despart, Chief Strategy Officer for Circle, a major stablecoin issuer, argues, "The law sets a clear standard that even large banks must follow if they issue payments in stablecoins. The fact that 102 Democrats voted alongside their Republican colleagues for the Genius Act indicates that it meets essential consumer protection criteria. I believe this bill represents the most significant financial regulation we have seen in decades, if not in American history, in terms of promoting a pro-growth, pro-competition, and pro-consumer agenda. Despite the backlash, the cryptocurrency sector remains optimistic, buoyed by substantial financial resources and the backing of President Trump. The Trump family has controversially engaged in the crypto space, with investments in World Liberty Financial, a company exploring various facets of the industry, including the launch of its own stablecoin. Looking ahead, the Clarity Act is now the next major objective for the crypto community. This bill seeks to diminish the regulatory authority of the Securities and Exchange Commission, SEC, which has been perceived as a strict enforcer of regulations against the crypto sector during the Biden administration. Under the leadership of former Chairman Gary Gensler, the SEC aggressively pursued the crypto industry, collaborating with the Department of Justice to prosecute former FTX CEO Sam Bankman-Fried, who was sentenced to over 20 years in prison for his actions. The Biden administration's goal was to ensure that crypto companies adhered to the same regulations as traditional financial institutions. However, crypto advocates argue that digital currencies are a novel financial product that requires a distinct regulatory framework, one that critics suggest the industry is attempting to shape to its advantage through significant political contributions. Mark Hayes, Associate Director for Cryptocurrency and Financial Technology at Americans for Financial Reform, warns, people could find themselves in a precarious situation, inundated with new products that come with less oversight and increased risk. We are conducting an uncontrolled experiment on our financial system using a technology that has yet to fulfill its promises. For the time being, however, the cryptocurrency industry is celebrating a significant victory with the successful passage of the Genius Act, and it continues to push forward.